Hi, I'm John Huang, and you're watching the Junior Investors Club. For today, we'll be talking about buying calls. But before we begin, quick disclaimer, I'm not a licensed professional, so I'm teaching theory in all my lessons. Therefore, any stock references will be only for educational and teaching purposes only. Most importantly, please portfolio size and do your own due diligence. Thank you. So we talked a little bit about this in the previous video. Today we'll be covering call options, right? And specifically how to buy them, right? Options, as you know, can be both bought and sold. And there's two types, calls and puts. So actually in the options world, there are these four basic options: buy call, buy put, sell calls, and sell puts, right? So today we'll be focusing on buying calls, right? So if you think about things in a logical manner, whenever you buy something, you own it. So whenever you buy a call contract, you actually own the right to buy the stocks. Okay. So try to wrap your head around this, right? You are buying the right to buy. Okay. And it's going to get a little bit confusing when I introduce the rest of it further down the line. But just remember that you are buying a contract that allows you to buy a stock at a predetermined price. Okay. Okay. So the thing you need to understand is because you paid money for it, you bought it, right? There is an initial value from the very beginning, but this value can change according to how much discount is available in your contract, right? So depending on how much discount is available for that contract, right? It can either become very valuable or not valuable at all. So for an example, when I have a contract that allows me to buy a stock at $500 a share, and the current market price is $501, then my contract is not very valuable because it only allows me to sort of earn a profit of only $1. But if, for example, the stock market is at $1,000 a share, right, then my $500 contract becomes very valuable because that allows me to purchase shares at a 50% discount, right? So that then you can see the value of that contract, right, that allows a 50% discount becomes very valuable, and there'll be lots of people who want to purchase it at a price higher than what I initially bought it for. And that's really the idea behind options. So another thing you need to know is that all these contracts have an expiry date, right? Similar like a lottery ticket or a discount coupon booklet, right? You purchase the discount booklet, right? And if you don't use it by the expiry date, right, it's useless. You can't use it at all. Similarly, your option contract typically will come with an expiry date. Okay, so if you don't exercise the contract or sell it away to somebody who wants to purchase it at a higher price, right? If you don't do any of that, then it's going to expire and totally disappear. So whatever you pay for it initially goes into the air, right? So let me go into the live demo and I'll show you what I mean. So I have my Thinkorswim demo account set up here. And for a buy call contract, you are looking for stocks that are going up, right? Because you want your contract to lock it down at a certain price. And further down the line, it's going to appreciate. And that's how your contract becomes more valuable, right? Like the example I gave just now. For this instance, currently the S&P 500 is running at $415, right? 415, right? And this is what we do. I'm going to choose to purchase a call option at the money, at the current price, and lock it down for the future because I foresee that it's going to, the S&P 500 is going to appreciate in the upcoming months, and I want to be able to lock down this price at its current position, right? So I'll go to the trade screen, and the first things first, we get to choose the expiry date, right? So we can choose how long we want our contract to run, and these little brackets, they tell you how many days to expiry from today, right? So a typical buy call, right? You can do like 3 to 6 months at a minimum, but you can go all the way until 2 years, right? If you do as a 2-year position, it's what we call a leap call. But if not anything shorter than that, it's a kind of a midterm or short-term trade, and that's more of a swing position, right? So I'm going to choose about let's think about 1, 2, 3 months out. So 20th of August, right? Maybe we go a little bit more, 17th September, right? We can go a bit longer, it's fine. Why do we say that when we go a bit longer, it's better? It's because we allow the stock itself to have more time to appreciate, right? It takes time for a stock to become more and more expensive, or become more valuable as time goes on. So we're just going to give it a bit more time, right? Of course, the longer you give it, right? Of course, the longer the expiry date, the more expensive the contract is, okay? So we can see that for a 120-day contract, looking at the current price, about 415, sorry. These are what we call strike prices, all right? These are what we call strike prices. And after choosing an expiry date, we actually get to choose at which price do we want to lock down the S&P 500 at, or the stock that we chose to lock down at. They usually run in round numbers, right? Sometimes there's a decimal, like 50 cents or something like that, but typically they run in round numbers. So we want to pick as close as we can to the current price. So we'll go for a 415 strike. And I'm going to explain to you what it all means, right? So I'm going to pick a 415 strike. What that means is that, if the S&P increases in price in the future, that means that my contract, which allows me to buy it at 415, should become more valuable, right? If the S&P becomes $1,000 and I'm able to purchase it at $415, right? I actually control a discount of about $600. You see where I'm coming from? So we have these two columns, the bid and the asking price, right? Typically when we sell, it's a bid. When we buy, it's an ask, right? So I'm going to purchase this contract, right? So let's take a look at all these details. So on this screen, we can see a few details of our contract. We have our price, $16.68, right? We have the strike, 415, which is what we control the price at, right? We have a type, right? The call or a put, right? It can be either call or put. I'll talk about puts at a later video, right? And we also have the expiry date, 17th of September 2021, right? Quantity. So we can buy actually multiple quantities, right? 1, 2, 3, we can buy 10, 20. There is a bit more extra things back here. Order, TIF, and exchange. That's a bit more advanced. So we don't necessarily need to touch that at this juncture. So once we are satisfied with this, notice that the prices actually do change. They fluctuate when the market is moving, right? So you may choose to haggle a little bit, right? Perhaps you go for a midpoint, right? $16.70, and then you can confirm. So let's take a look at this screen, right? This screen is very important because it really gives you a lot of details on what you need to know, okay? So take a look at this. Maximum profit and maximum loss, right? Okay, so this one, you should pay very close attention to this part, right? Because we are purchasing, we buy the contract, therefore we are paying the money, okay? We are paying the premium, they call it, for this contract. And the premium is $16.70. So of course, in the options world, you have to multiply everything by 100 because this is simply the price of one share, right? So you have to multiply by 100. So what it's telling us that for $16.70, we actually control one S&P 500 at 415, right? And then of course you multiply that by 100 because each contract controls 100 shares, And that's how you get your maximum loss price of $1,670. Okay. The next thing you need to know is that the max profit is infinite, right? So you can see that the risk reward for doing such a position is pretty good. Okay. Why do they write infinite and what does it mean? The S&P or any stock in fact can go to as high as it wants to go. And the higher it goes, the more valuable the contract becomes. Inversely, if the contract goes downwards, right, becomes less valuable, the stock price, if the stock price drops, right, the contract becomes less valuable as nobody wants to buy it, right? If the stock market, if the S&P drops to $300, nobody will want your contract to buy it at $400. Why? Because the market is cheaper than your contract. So they will just buy directly from the market and your contract will be valueless, right? Or it will lose its value until it becomes valueless, right? So once we understand all that, we can simply press confirm and send, right? Let's send the order through and we've sent our order through, right? So let's take a look at this, right? So currently the S&P is at 415. And let's go into the future. Okay, so this is our order. Before we do that, let me purchase some shares to show you a comparison as well, right? So at the same time, I'm simply going to buy 100 shares. Right? 100 shares at 415.38.39. So take a look at this and try to remember these numbers as well, right? Initially, we paid 1,600 for a call contract to control 100 shares. On the flip side, there are people who prefer to do stocks trading, right? And they are just going to buy the shares outright, right? So to buy 100 shares is $41,539. Okay, so it's a lot of difference between $1,000 and $40,000, right? But they actually do the same thing, right? Except the capital outlay for options are much lower because of the leverage, right? So let's just send this one through and see what happens, okay? Right, so both positions are in, right? Remember our trade price, right? This is what we initially paid for, right? $16 for the option contract and 415 for the stocks, right? Times 100 times 100. So it'll be 41537 and 1615, right? Simple. And the market price, right? In the next column, we look at market, right? This tells us what the current price is, okay? The current value of the positions, right? So currently we can see the S&P is moving 415.4, right? We bought it at 415.37, currently 415.42. So you can see that we're already earning a little bit of profit of about $7, $8, $9, like whatever, right? Similarly, because the stock is moving and becoming more valuable, our contract becomes more valuable as well. So 1665 currently is running at 1668, right? So we've already profited about 3 cents times 100, so it's $3.50. So let's move on to the future and see what it looks like when the stocks really move very far, right? So let me go towards the future, May, June, July, August. We have until September. It's August, September 20. Let's go until before it expires, 17 September. Let's go until 16 September, right? Let's go and look at it one day before the expiry date. Right, so we are at September 16, right? And we can see that, you know, after some time has passed, the S&P has increased in price, right? Remember, we bought it at 415, current price is 447. So that's about $30 of profit, right? $30 difference per share, right? And you know, that's about a 7% profit, right? So from May to September, there's about 3 months, right? In about 3 months, we earn about 7%. And that 7% equates to about $3,000, right? Now, on the other hand, let's take a look at our call option, right? We purchased it at $16, right? And currently, because the S&P has increased in price and we are able to purchase the shares at 415 when the current price is 447, that allows us a profit or that allows us a control of about $30 profit, right? The current price of our contract from $16 has increased to 32, right? That's about a 94% increase, or about that equates to about $1,565, right? So let's take a quick look at the chart just to be clear on seeing what's happening, right? So now we're at our charts, and just to show you what it looks like, we bought it here, right, around 417. Right, and we are currently here, right, somewhere here. So it's about 6.5. I mean, it's seen on the other chart, it's about 7% increase, right? So within the 3 months, it's grown only 6 or 7%. And if you are doing stocks, it's that percentage. But if you're doing options, that contract actually multiplies by a lot. Okay, so let's take a look at these numbers here. The beauty of options is that your capital outlay actually is not as intensive as your purchasing the stocks, but the results are similar, right? We are talking about efficiency here. Okay, so for $1,000, you can easily double that amount. Okay, so we've almost reached 100% and 94% simply with a 7% increase on the stock market. Okay, so a 7% increase means 100% increase on your options contracts. Okay, whereas your stocks will just move in a one-to-one value, right? 415 will become 416, 417, 418, depending on what you started out with, and depending where you end up with, then they'll calculate that difference as a percentage, and that's what you get, right? But the capital outlay is a lot more. See, for $40,000, you are only able to generate 7% within 3 months. Whereas for $1,000, you are able to generate 100% or double that money within 3 months, right? So I'm able to actually sell my contract at almost double the price. Whereas if I sold my shares, I'm only getting about 7% profit. And that's really the beauty of these contracts, right? Another side note, because you are, remember, a buy call allows you to buy the shares, right? Allows you to buy the shares. So if you do happen to have the money sitting around and you actually want to purchase the shares, you actually can, right? You only require $41,500, right? Let's take a look. It's over here. $41,500 sitting around your apartment to be able to purchase the shares. And you will be instantly in profit because you can straight away sell the shares at 447, right? So that's the power of it. You don't have to, but you can if you want, right? That's the beauty of being an owner of a buy call contract. For majority of us who are options trader, we typically don't exercise the contracts. You can if you want to, but you don't have to. There are instances where you do. For this example, we won't, right? It is not necessary. We can simply sell the contract away to earn our profit, right? So we can actually, let me show you how I do this again. Right click, create closing order, and we're gonna sell away our buy contract, right? Confirm and send, and we will receive $3,231, right? Initially we paid $1,600, then we'll receive back $3,200, right? That includes the 16. The 16 is already added in, then the rest is profit, right? So this is how we capitalize on leverage, and this is how we do buy contract. Of course, you do need to do all of these things, whether you exercise or you sell the contract before the expiry day, right? I didn't mention that we have the days over here, 2 days left. If you don't do anything before the end of it all, right, the contract simply vanishes, right? And you don't get your profit, right? You don't collect your winnings before the expiry date, and then it simply goes back into the pool, right? So you have to remember to do that before it expires. If you do stocks do not have an expiry date, right? They last forever, but options, you choose a date, right? You get to choose a date that you have to act upon by, right? But if you don't do anything, then it's just going to disappear. So you must remember not to let it slide until beyond the expiry. Then you cannot do anything anymore, right? So you can see how powerful options are in terms of capital efficiency. In the first example, right, we are using $41,000 to generate 3,007% profit. And on the other hand, we are only using 1,600 to generate about 100% profit, right? We almost double our money. And it really is more efficient than purchasing stocks, right? There are instances where you want to purchase stocks. There are instances where you use options instead, right? For me, I'm flexible with both, but today we cover this. So if you found this helpful, please like this video if you really enjoy this sort of content. If you know someone who is interested in this sort of thing, feel free to share it with them as well, right? And if you want to learn more, all right, I'll be producing more of these videos, right? It's just the beginning. So subscribe if you want to be notified, and yeah, I'll see you guys in the next video. Bye.